So Andrei Jikh said recently that there was a problem with dividend investing in the video he posted on social media. And we checked. Guess what? There is no problem. So if you want to know more about this conversation, stick till the end of today's video. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to talk to you about Andrei Jikh and his video around the problem with dividend investing. And again, we checked, we don't see any problem. Before we get into the nitty-gritty, please understand we love Andrei Jikh. As a matter of fact, he's one of our favorite creators on YouTube. And so this video is not about having some kind of intellectual conflict. It's about enriching the conversation. So we're just trying to show another view of the topic. We're trying to bring our 2 cents to the debate around dividend investing. So we believe there is no problem with dividend investing. It's a great strategy that is part of the portfolio management approach for millions of Americans and people around the world. So here are some, just kind of recap the premise of today's conversation. Andrei Jikh gave 5 reasons why he believed there is some kind of issue with dividend investing. So we're going to go to every reason and we're going to give you our view about the issue. So reason 1, Andrei Jikh said that dividends, so there is a problem with dividend investing because dividends are not guaranteed. So he said in 2020 there were dozens of companies that cut their dividends. It's not a contract between us and a company that will be paid dividends. At any moment, companies can hugely decrease their dividend payout or even worse, completely get rid of the dividend, and there is nothing we can do about it. So that was Andrei Jikh. So here is our response here. In theory, when you really think about it, it's not a bad thing if a company cuts its dividends. The most important thing is, why did the company cut the dividends in the first place? That's the conversation we should have. So when you look for companies to invest in, you'll find some companies pay dividends regularly to stockholders and provide them with a regular income stream, right? So what happens to companies that don't pay dividends then? How does this benefit stockholders rather? So if you invest in a company that reinvests its earnings, the business is usually seeking to expand and wants to invest earnings in areas that will grow company sales, right? Think about it. Microsoft for many years, many decades, many years did not pay dividends because they were reinvesting the cash into the business. So when company growth translates into a higher stock price, you will earn capital gains if you sell your stock at a price higher than the purchase price. So that's the greatness here. So reasons for reinvestment: a company can decide to reinvest its money for several reasons. So younger companies reinvest profits to support cash flows, for example, and those cash flows are needed to pay for current debt and expenses. Reinvested profit can also be used to open new store locations, right? To perform research on new products and services, to provide operating assets to be used in the business, or even to buy investment assets. So companies that once paid and have stopped paying dividends may have insufficient cash flow to support a dividend payment, and that may be cause for concern. So slow market or sector lethargy or business conditions can also contribute, if you think about it, to a company's decision to retain earnings. So what I'm trying to say here is that companies can stop paying dividends, and that's not a bad thing. It's not a bad thing per se. For instance, we can even have a conversation around access to financing. So if a company's access to financing is a little detrimental, this could also affect whether earnings are reinvested. So the ability to borrow money can be difficult when the cost of borrowing is high, such as when interest rates are rising, or for instance, the company cannot obtain financing due to financial problems. So the reinvestment of profits is important to maintain the company in business and provide with cash flow to sustain its operating needs or growth objectives. So the picture I'm trying to paint here, just to recap, is if a company stops paying dividends, it's not a bad thing for the investor. Reason number 2, so Andrei Jikh said that there is a problem with dividend investing because, and I'm quoting here, dividends limit total returns because when a company is paying out a dividend, it's another way of saying that they have run out of ideas to grow. It might be also a signal of a declining company. Because it's no longer growing, the stock price tends to increase less than that of growth stocks. So this was Andrei Jikh, and we're just saying here that this is not always the case. Not necessarily. If a company stops paying dividends, it could also mean that there is no attractive opportunity out there. In that case, it's better to return funds to investors or buy back shares to prop up share prices. So if a company is not paying dividends, they might use the money to buy back shares, right? So the company, an organization may choose to buy back outstanding shares for a number of reasons. So repurchasing outstanding shares can help a business reduce its cost of capital, the WACC, the weighted average cost of capital. They can also use it to benefit from temporary undervaluation of the stock, consolidate ownership, inflate important financial metrics, or even free up profits to pay executive bonuses. So let's talk a little bit about internal rate of return, because it's an important element. If a company is not paying off dividends, has stopped paying dividends temporarily, it's because maybe they're thinking that there are projects out there that are either attractive or not attractive. And if there is no attractive opportunity out there, they will buy back shares. Now, what is the internal rate of return? This is the investment return on capital expenditures or investments, ignoring external factors. So this is usually determined as a percentage. So if this is actually the interest rate that makes the cash outflows spent on an investment equal the cash inflows that come into the company as a result of the investment. So alternatively, the way I want you to think about the IRR is that it is an interest rate that occurs when the net cash related to the investment equals 0. So companies use it, even though it might seem a little difficult to understand, it is straightforward. So companies use IRR to determine if an investment, project, or expenditure was worthwhile. So calculating the IRR will show if a company made or lost money on a project. So this kind of ratio makes it easy to measure the profitability of your investments and to compare one investment's profitability to another. The reason why I'm just saying that is because if there is no project with a better IRR out there for the company would rather just take the cash and either keep it to expand or do what? To buy back shares. So it's not a bad thing. Reason number 3, so Andrei Jikh said that the problem with dividend investing also had to do with the fact that dividends are not free. And I quote him, "Dividends are not free, and you will pay more in taxes. When a company pays out money, the stock price drops by the same amount. You're just taking money from one place and putting it somewhere else. Like a transfer from your savings account to your checking account, dividends you receive are taxed. So you're forced to pay capital gains on dividends, where in contrast, growth stocks don't pay out, so there is no forced withdrawal, so you don't get hit with taxes." Again, I was quoting Andrei Jikh. Now, Andrei, we love you, but I just want to have a conversation around taxes. What is wrong with paying taxes? I really don't understand why some investors are so fixated on taxes as a bad thing. Most investors wouldn't say no if a company offered to send them a check. And that's kind of what dividends are like. But at the same time, paying taxes on that money isn't as popular. So basically, what people say when they say, well, it's a bad thing for taxes, this is like you want to enjoy the benefit of the steady payment from a company you are invested in that comes in the form of dividends, but you don't want to pay taxes on that cash. I mean, certainly, you can hire a clever accountant who can work this out for you. That's for sure. But for most people, paying taxes is part of the reality when it comes to dividends. The good thing is that most dividends paid by typical corporations qualify for a lower tax rate of 15%. Sometimes it's even 10%, 10, 15, or 20%. So that's way below the standard tax rates due on ordinary income. So what I'm trying to say is that there's nothing wrong per se with paying taxes. And investors have to embrace that idea of paying taxes. Now, with that said, there are some legal ways that where you might be able to avoid paying taxes on your dividend. So those include, first, don't make too much money because taxpayers in the tax bracket between 25% qualify for the 0% tax rate on dividends. So for 2020, you would have earned less than, we put on the screen here the limits, the thresholds according to the IRS. So if your taxable income is is less than 39,375, you pay 0% on qualified. You pay 0% tax rate on qualified dividends. If your income was between 39,375 to between 39,000 and 435,000, the rate is 15%. And if it's above 434,550, the rate is 20%. And that's if you're a single filer. So if you're married, then you see it there. It's from 0 to 78,750, 78,751 to 488,850, 15%, and above that you have 20%. So those are the rates for 2020. So if you make less money, yeah, of course, then you don't have to pay taxes. One thing I want to say also is that when people talk about taxes on dividends, you have to think about there's something called DRIP, dividend reinvestment plan. So that's the DRIP. So let's quickly talk about that. So because if you reinvest the cash, you can do it either manually or you can sign up with some kind of plan to do it for you. Reinvesting dividends is the process of automatically using cash dividends to purchase additional stocks of the same company. So if you choose, for instance, to reinvest your dividends, you'll have to pay taxes as though you actually received the cash. So some companies modify their dividend reinvestment plans by allowing shareholders to purchase additional shares of stock at below market prices. So in this case, the difference between the cash reinvested and the fair market value of the stock is taxed as ordinary dividend income. So some companies do not pay dividends to their shareholders in the form of cash, but rather in the form of additional company shares. So stock dividends are generally not taxable. They're not taxable until the stock is sold. So this exemption is generally forfeited if the company allows the investor to choose between stock or cash dividends, in which case the investor is taxed even if he or she chooses stock dividends. Another way to actually quote unquote dodge taxes when you receive income, dividend income, is that, and it's tax-free dividend account. So you just have to open a tax-free dividend account that companies can create for their shareholders, and that's known as the CDA, the capital dividend account. So with this account, capital dividends come from paid-in capital rather than retained earnings. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're having a conversation today around a video that YouTube creator, one of our favorite YouTube creators, Andrei Jikh, posted recently about a hypothetical problem with dividend investing. And we checked, there is no problem. And this video was about just showing another view of the like bringing our 2 cents to the conversation. We're trying to make investors understand that dividend investing is more complex than that. It's not just, we can't just say it's a bad thing. There are several ways to create a good portfolio, an optimal portfolio with through dividend investing. So reason number 4, Andrei Jikh said that dividend investing, there is a problem with it because it decreases diversification. And I'm just quoting him here. So he said, if you are investing in dividend stocks, that means you are only investing in large established companies, otherwise known as large cap stocks. But you're missing out on the new up and coming companies that have the potential to be the next Tesla, the small cap companies. We just say here, dear Andrei, this is not true. There are tens of small and mid cap dividend stocks you can buy. You can go to Yahoo Finance or Bloomberg or Kiplinger, and you have plenty of information. You don't have to put all your cash in large cap dividend stocks. By the way, folks, when people talk about large cap, small cap, and mid cap, they're talking about large cap means that the company has a market capitalization above 10 billion. If you have a mid cap, it means the company has a market capitalization between 2 billion and 10 billion. And when the company has a small capitalization, it means that its market capitalization ranges from 300 million to 2 billion. So I was talking about you can actually buy there are a lot of plenty mid cap and small cap dividend stocks out there. You can also allocate money to other assets, including bonds. So speaking about the diversification, there are several ways to achieve it. So when people think about diversification, it's not just about investing. So if you're investing in dividend stocks, then you are only selecting a catalog of large established companies, as Andrei said. No, you can diversify within your portfolio. In other words, you can buy assets, stocks, bonds, and mutual funds, ETFs, to make sure that there is no perfect correlation. So you are achieving an internal level of diversification. Because when you think about diversification, you got to think about what I call two ways. You have endogenous and exogenous. So endogenous diversification means that your portfolio, the components, the holdings within the portfolio, the assets that you're buying do not exhibit a perfect correlation. So if something happens to one class of assets, you are able to ride it out. You're able to ride the market correction out. So for instance, what I mean by that is, for instance, you can have stocks, bonds, ETFs, mutual funds. You can have some alternative investments. You can have some commodities, gold, silver. You can also have some real estate, if that class of asset fits your risk tolerance. So that's diversification in terms of asset class. You can also diversify within the industry you're buying. So you can choose a stock, tech stocks. You can choose finance. You can choose consumer goods. You can choose. So there is a variety of stocks you can buy. So the idea here is that, and this is the basis of today's conversation. When Andrei Jikh says that by buying dividend stocks you're not diversifying, it's not true. There are other ways to diversify your portfolio. And reason number 5, this is one of our favorite. And Andrei Jikh, one of our favorite YouTubers, said that, and I'm quoting him here, dividends are only advantages emotionally and nothing else. Dividends don't provide any real benefit over growth investing other than making you sleep well at night. I think he was a little, I don't think he was a little serious here, but I'll just say this is not true. When we're talking about dividends, we're not talking about emotional things here. Dividends constitute real money on which some people depend entirely to live. Buy groceries, put food on the table, just live. So dividends, there's nothing, it's real money, folks. It's real money. If you buy dividend stocks, it's real money coming to you. There's nothing emotional about it. What I want to mention here is that dividends are part of what people call fixed income. When you have a company that is able to pay, a large company or a mid-cap company that is established, that has access to sufficient cash, that's doing very well, it's really fixed income. So if you are in your 40s, 50s, or 60s, especially when we go up in the age continuum, I'm talking here in terms of 50s and 60s, you have a lot of people relying on dividends to live. And it's the same way as the interest, the coupon you receive when you invest in bonds. So all those two categories, actually there are several, but I'm just giving 2 or 3 here. So when you have dividends from common stock or preferred stock, or you receive coupon income from interest income, that is from bond holding, it has nothing to do with emotions. It's not about sleeping well at night. No, it's about putting food on the table. It's about transforming your life. It's about optimizing your portfolio. It's about reducing the risk that your portfolio is showing. So the bottom line here, folks, and I want you to really, this is what I want you to understand here is that, and I'm just recapping here. Andrei Jikh, we love you here at the Sweetie Kiwi Show. We have watched tons of your videos, but there is no problem with dividend investing, because dividends provide real income, because dividends invested in dividend stocks can also be great for folks who are interested in diversifying. And in terms of taxes, there is nothing wrong with paying taxes on dividends. If the company has if the underlying security has appreciated interestingly, and the company is paying healthy levels of dividends, there's nothing wrong with paying 15% or 10% here and there. And also, we want to say that dividends do not limit total returns at all. If the company is not paying dividends, it could mean that there is no attractive opportunity out there. In that case, the company can either keep the cash or return funds to investor or buy back shares to prop up share prices. And the last thing is, when you are a dividend stock investor, the ability here is to be in it for the long haul. You want to really be in it for the long haul, so that you're not scared about the temporary yo-yo that you see in the market, because markets are like that. They go through temporary yo-yos, that's for sure. All right. I will see you next time. Thank you so much for watching this conversation. We really appreciate it. And until then, remember, stay marvelous.